because you're puking what could be the short-term high, right? If the market trades above the swing, there's always a chance that it's just doing so, grabbing liquidity to then see a new leg lower, and then you're left wondering, why does it stop you out before it goes, right? I'm sure that many of you can relate to that. So with the idea of placing the stop above and below the thrust, you are eliminating those two things, which is what causes so many problems. The only entry module that you will ever need, traders, what you're going to learn in this video is probably going to be the most powerful concept that I've ever taught on this channel. What you're seeing over here in front of you is an Excel sheet of a mechanical edge that I'm currently testing using this very same entry module that you're going to learn in this video. Now, here are some of the traits. This is how the module looks like, and you're going to learn everything about it in this video, which is to say when it happens, what's the actual pattern that you're looking for, the contingencies, everything needed to make this pattern work. So you gotta make sure that you stick to the very end of the video, because everything is gonna be covered in a lot of detail. Alright traders, so I've brought you back to the whiteboard. This is where I usually like to do my explanations, and what you see drawn over here in front of you is the actual trading module itself. Now, you have to remember that this trading module without context doesn't mean anything. And once again, when I say context, I don't mean a higher time frame bias or narrative. It could be as simple as having a mechanical strategy where you say, hey, I'm going to execute this module every time it happens if it forms between 9:30 and 11 on the NASDAQ after a 15-minute sweep. That could be a strategy, for example, that you could test, right? So what I'm saying here is that you don't necessarily need a higher time frame narrative or bias to execute this module. You can just simply look for different variables that happen every day. And what I mean by this is look at the time, because time is a variable that occurs every day and it doesn't allow any room for thinking, because when it's 9:30, it's 9:30, and when it's 11, it's 11. And test how you can use this entry module into that mechanical edge that you're trying to build. And we will go over building mechanical edges in the future, but for now, remember that, okay? So you're not using this blindly every time it forms. You're using this whenever you have a reason to do so, which once again, as I've explained, could be a higher time frame bias, could be a specific time, could be a specific sweep, could be a specific asset class, right? I don't know. That's for you to decide. You can implement this module to anything that you would like to trade, but it's important that you don't go out there in the charts blindly looking for these things without the proper narrative, because otherwise you are going to lose money, guaranteed. Now, with that out of the way, let's dive into the actual trading module. The trading module is simple, okay? It's a simple change in the state of delivery, and there's some discretionary decisions that go into it, but most of it, I'd say like 90% of the module is mechanical, and you will see it. Now, this is a module to enter reversal, so you're only going to be looking for this sell module, which in this case is this one to the left here, when the market is going up, and the opposite is true for a buy module of this sort, which is to say that you're only going to be looking for this when the market is going lower. Now, where is it going lower? That's not for me to decide. As I said, we're just focusing on the actual entry point. So with that said, in this particular example on the left-hand side, we have the market moving up. And the important thing to notice here is, as the name says, we're looking for a change in the state of delivery. Change in the state of delivery. And it's very easy to see. We're just looking for any leg opposite to trend, in this case, that breaks the market structure, which is to say that we get a market structure shift. We need to see strength in the candles, okay? And this is where I see most people get this module wrong and why they lose money. It is because they don't understand that we need to see displacement. If we just have small candles retracing and moving gradually lower, then you should not expect that the fair value gap, if it even forms one here, is gonna work. You're more than likely just gonna see a new leg high, and this is where the timing of the market is important. You need to see real displacement lower. You need to see big bearish candles. We need to close below the market structure shift point. Okay, it is not valid if we just wick below it and close above. In this case, you'll need to see the market close below the point that created a new high here. And at that point, once you get that and you've closed below it and accepted it, the more time we spend below this area, the better. Obviously, you don't want to see this go all the way down without you, but you do want to see it close below and accept below. Once you get that, you're then going to be looking for a fair value gap, and you're going to be looking for the closest one. It could be one below the market structure shift point. Okay, it is important to understand you're looking for the closest one to enter the trade with your stop not above the high, which is as most people do, which is wrong, but above, in this case, a thrust candle that forms on the way down. Remember, guys, you're only looking for this when you have displacement, and when we have displacement, a thrust candle will form, which is to say a wide-ranging candle that ideally opened above the market structure shift point and closed below it. Very important concept that not many people know about. You need to place your stop above, right, a thrust candle that closed beyond the market structure shift point, which is to say anywhere here to here, and closed below it, right? So let's say in this scenario, we get a candle that closed above here and closed well below the market structure shift point. This would be your stop. Now, sometimes it will coincide with the swing, but you're not placing your stop loss above the swing just because you think you're swing protected. You're doing so because that's the thrust candle. You need to remove the idea of placing your stops above and below swings. You're only looking to place them above and below thrust, and there's several reasons to do so. Number one, the impact and the likelihood of slippage is a lot higher when you're placing your stops above and below swing points, okay? Which is to say that you will get slipped more often than not if your stop loss is above swings, because the market tends to aggressively push through them to grab liquidity and then potentially reverse, right? Another reason why is because you're puking what could be the short-term high, right? If the market trades above the swing, there's always a chance that it's just doing so, grabbing liquidity to then see a new leg lower, and then you're left wondering, why does it stop you out before it goes, right? I'm sure that many of you can relate to that. So with the idea of placing the stop above and below the thrust, you are eliminating those two things, which is what causes so many problems. So hopefully the module was understood. It has nothing to do with the fact that there's equal highs here and we run them and then shift. All you're looking to do is see a market structure shift with this displacement, candles closing above the market structure shift point, accepting there. You're looking for strong candles, which is to say that you don't want to see the market slowly grind above the market structure shift point. Let's say this is looking like this. The market was going down, right? And you're seeing the market structure shift here. Although correct, this is not what you're looking for, because more often than not, what you will find is that we're just going to clear liquidity above that high and we're going to run back down straight into a new low. And you don't want to be part of that. You want to see clear intention. This is a change in the state of delivery. You need to see the market structure really showing you that we're now want to move lower, which is why we require displacement and thrust candles. And once again, you're going to enter at the open of the closest fair value gap, which once again could be here above the market structure shift point, or could be here within the 50% of the pullback retracement of the overall leg. That's irrelevant. You're looking to enter at the market structure, at the fair value gap, right? With a stop beyond the thrust, not below or above a swing, and whatever you target is once again up to the module you trade. I am only showing you how you can enter the marketplace with a high degree of success if the context is correct, which is the most important thing to get right, because anyone can learn the specific market pattern. Okay, hopefully that was helpful. I will be giving you now the key. Displacement is needed. Stop loss using thrust candles. You're no longer going to be using swings, which is what many people teach and is so wrong and gets me so agitated. Nonetheless, that's what it is as of now. Stop loss above and below the thrust candles, acceptance below or above, right, the market shift point. And that's about it. And obviously a fair value gap formation, which is granted if you have displacement. You cannot have displacement without a fair value gap formation. So these two go hand in hand. Hopefully this was educational. What we're going to be doing now is going over the module that I'm testing. Now, I'm not going to say what the module is because I don't even know if it's profitable and I don't want you guys to go ahead and trade it without stats. But I'm going to be showing you how the entry techniques do work with the module. So with that said, we're going to be jumping right back into the charts and I will see you guys there in a second. All right, everybody. So once again, these are all trades taken from the mechanical edge that I'm currently testing. And as I said in the beginning of the video, I don't know if this is going to be profitable long term. As I said, if you look to the right of the screen, it started off fairly well, but now it's pulling back to the mean, which is what tends to happen with most mechanical edges. Nonetheless, we want to focus on the actual entry points, okay? So let's go over here. I've picked a winner, a loser, a winner, and a loser. And we're going to be going over them to outline the characteristics that we've spoken about. So number one, we need to see a market structure shift. When we have this leg up, the market structure shift point would be here. Now, do we close below it with displacement acceptance? That's the step two that you need to ask yourself. The answer is yes, right? We see few consecutive candles, all denoting bearish price action with relative strength and confirmation to go further short, right? So these two steps are now covered. We have, once again, a market structure shift with a displacement lower and acceptance. Once you see this, do we have a fair value gap? The answer is yes. We have one here and we have one here. But as we said in the whiteboard explanation, we're looking to enter at the closest one that forms, obviously, because we want to make sure that we get into the trade. Yes, if you wait for this one here, you might get higher risk to reward trades, but you're going to find that you're going to miss a lot of good opportunities, which in my experience is not going to be optimal or it's going to pay off to do so. It's actually much more profitable if you just take the first fair value gap with a slightly bigger stop loss. So where do we place our stop loss? We're looking for a thrust candle that opened above the market structure shift point, which is here, and closed below it. In this case, you have several candles. You have this one here, right? This would have been a great stop loss placement and it would have provided a tighter stop loss. But in this scenario, I decided to go for this one. Now, why this one? It did close below this low here, which although not being a market structure shift point, I apply importance to candles that closed below lows if they actually opened above them, which this candle is. But I wouldn't have said that placing your stop here would have been a wrong idea to do. Although you do have a fair value gap there, you could be potentially puking your stop loss into a fair value gap, which is why I went with this candle here. Note that my stop loss is not above the swing point, but rather the thrust candle, which is more important. And in this particular module, I'm targeting a fixed 1 to 2R, and that's irrelevant now. But this is the actual entry technique. This should now be familiar to you. And it's not always gonna work, but it will work more often than not. Moving on to the next example, we have the very exact same thing. We have the market structure shift point being here. We have the market closing below it with displacement. You can see this big candle here and this candle there. We have a fair value gap formation denoted in orange, as you can see here. And we have an entry there. So that's your entry. I'll place my stop above this thrust here, although you could have potentially placed it above this thrust there, this candle there. But obviously looks like this mechanical edge, executing it on this particular time, was not profitable. But once again, has nothing to do with the entry technique. Okay, remember what I've said in the beginning. This is just a test of the entry module, and it will depend on the performance of it on the higher time frame narrative or mechanical edge that you're implementing it in. Very important to understand. Moving on, a bullish example here. Once again, market structure shift point being here, closed above and acceptance above. You can see that the fair value gap forms above the market structure shift point. As we said, it doesn't really matter at that point as long as there's a fair value gap and you enter there. I decided to enter in the 50 because I thought that would make for a better risk reward ratio, considering my stop loss placement. Okay, you can tweak this, but I'm just giving you the overall definition of it. The stop loss, as you can see, doesn't go below the swing point, which would be down here, but it goes below the thrust. This is a big wide ranging candle that opened below the market structure shift point and closed above it, therefore becomes my stop loss placement. Lastly, over here, another bearish example. This is a loser. We have the very exact same thing, market structure shift point, displacement through it, stop loss above the thrust and not the swing, although sometimes you will technically be placing it above the swing if it's close enough, but you're not using the swing point principle, you're not using the thrust principle. We close and accept below it. As you can see, we get filled here. Yes, we do run lower initially, but then it pulls back and would have stopped you out if you were going for a 2-hour winner. This was my explanation on the only entry technique and module that you will ever need, and I hope to see you in a future video.